drop in the price of gold is not going to be very much. It already is not that much when you're talking about 4,000. But wait till it's 10,000, right? Then $100 is an even smaller move, 1%. It doesn't matter to gold and silver if the Fed cuts rates or not. What matters is they're not raising rates, and they should. Interest rates are too low. They were too low before they were cut. They never should have been cut. And because they were cut, and because everybody knows the Fed's not going to hike, no matter how high inflation rises, well, that's bullish for gold.
What the Fed is saying without saying is that we're in for stagflation, and, makes me nervous, because to say we're in for stagflation, the obvious corollary is, so that's good for gold and silver. But with gold over $4,000 and silver close to 50,
how much better can it get?
Right, and I'm sure you have plenty of guests who argue why it has to go to 6,000 or 10,000 or whatever.
Gold and silver are entering a moment where short-term volatility barely matters compared to the structural forces pushing them higher. As Peter Schiff, chief global strategist and founder of SchiffGold, emphasizes, a $100 move in gold is insignificant when the market is operating near $4,000, and it becomes almost invisible once gold advances toward $10,000. What drives this market now is not whether the Fed cuts rates, but the simple reality that it cannot raise them. Policy is trapped. Inflation remains elevated. Real yields are profoundly damaging, and Washington is pressuring the Fed to maintain liquidity to avoid recession. That dynamic is inherently bullish for monetary metals. Lobo Tiggre, founder of the Independent Speculator, reinforces the same theme from a different angle. Markets are adjusting to a world where stagflation is not a risk, but a baseline asset. Bubbles in crypto, AI equities, housing, and long-duration tech are deflating at the same time the bond market weakens, creating a natural flight towards safer stores of value. Silver's sharper volatility is not a warning sign, but rather a classic early breakout pattern. It temporarily shakes out nervous investors while positioning the market for a larger move once confidence returns. As speculative assets unwind and policy becomes increasingly inflationary, gold and silver regain their place at the center of defensive capital. Investors seeking stability are rotating out of high-risk trades and back into tangible monetary assets, a trend that historically strengthens as the cycle matures. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
What the Trump administration is trying to do is make it worse, but flooding the economy with more cheap money to sustain a housing bubble is bullish for gold and silver. It's just another development on the week that is going to drive more money into gold and silver out of U.S. dollars. Look, this whole bubble is deflating in crypto, in AI, housing, right? In the bond market. Look at bonds getting beat up, and they're doing whatever they can. They have to stop. I mean, they don't have to, but as far as they're concerned, they have to, because they can't allow a recession or a financial crisis, even if in the long run it's something we need. In the short run, they don't want that, right? The Trump administration, all they care about is making the economy look good until Trump leaves office. The last thing they want is the bubble to deflate while he's still there, right? And so they got to do whatever they can to blow as much air into this bubble. That's going to mean maximum pressure on the Fed to cut rates, which is why the Fed's going to cut rates. And when they get a new FOMC chairman in there, they're going to go even more. The Fed's going to go back to QE to prop up housing, to prop up the market. Maybe they'll think they can prop up Bitcoin. Who knows? I don't know if there's any way to get the air back in that bubble. There's probably too many holes. But since the president's family is all in on crypto, they're obviously going to try to do what they can with cheap money. And so all this is going to drive the dollar down. Surprised it hasn't already dropped, but it's going to drive gold and silver prices much, much higher. So as I said earlier in this video, a volatile week, but all the dips were buying opportunities. Don't be afraid, right? A lot of people, they see this volatility and it scares them out of the market. at some point, $100 drop in the price of gold is not going to be very much. It already is not that much when you're talking about 4,000. But wait till it's 10,000, right? Then $100 is an even smaller move, 1%. And the volatility in silver, I think it's all a positive. It's all a sign of a breakout, but it is keeping some investors who might otherwise buy on the sidelines while they watch as speculators as the market keeps going up, and they're too afraid to come in. At some point, that fear will be replaced by greed. We're not there yet. All of the greed is still in Bitcoin. Now, eventually, that greed is going to turn into fear. And that's when the bottom is going to fall out of the crypto market. We're not even close to the bottom yet, right? We got a long way to go down, but we have a long way to go up in gold and silver. And, as more and more people have confidence in gold and silver, they're going to lose confidence in Bitcoin and the rest of crypto. I think that today's sell-off was another buying opportunity for SchiffGold customers to go to the SchiffGold website on Friday, on Saturday, and even Sunday morning, because I expect another big run-up in gold and silver prices Sunday evening into Monday. Now, maybe it won't be sold off in the U.S. time zone. What I've managed to notice is that the big sell-offs happen later in the week, not earlier. So there's a good chance that we get a big run-up on Sunday night and then an even bigger run-up on Monday morning as Americans who got out of their silver and gold rush to get back in. So it's another great weekend buying opportunity at SchiffGold to load up on gold and silver in particular, which I think has got an explosive move that's coming. But a lot of other things happened that are bullish this week, fundamentally, for both gold and silver. Bitcoin that MicroStrategy bought, right? Michael Saylor, on behalf of MicroStrategy, he spent over $47.5 billion, and God knows what he spent over the last week, because this is the number as of the prior week. He's going to announce on Monday how much money he blew this week, right? But over $47.5 billion to buy more than 640,000 Bitcoin. His average price is just over $74,000. Now the price is a little over $94,000, $94,700 as I speak, right? It's selling off a bit. That is a 27% gain over 5 years of buying. So MicroStrategy, right? Michael Saylor is going all around the world telling everybody that Bitcoin is the greatest asset that there is, that U.S. government should just sell all of our gold and we should just put it all in Bitcoin, that everybody should just buy Bitcoin instead of real estate, instead of precious metals, instead of stocks, because the returns are going to be so phenomenal, it's going to dwarf everything else, that there's no point in being diversified. In fact, you shouldn't just put everything you have into Bitcoin, according to Michael Saylor. You should put everything other people have. You should borrow money so you could put more money into Bitcoin than you actually have assets, right? Go into debt, according to Michael Saylor. Bet the farm, mortgage the house, right? Take out a loan against your business and buy Bitcoin because it's so great. He is up 27% over 5 years of buying. That's it. I mean, if Michael Saylor had simply, every time he went to buy Bitcoin, if he had bought gold instead, had he bought silver instead, had he bought the S&P 500 probably, he'd have more money today than he has because of all the money he's squandered on Bitcoin. But the other big difference is he can't sell. That 27% profit means nothing. It's on paper. He can never realize it. Had Michael Saylor bought $47.5 billion worth of gold over the last 5 years, and he'd be up way more than 27%, he could sell it all. He could actually realize those profits if he wanted to. It is impossible for MicroStrategy to ever realize any profits in Bitcoin. All it's going to do is eventually go bankrupt, and the Bitcoin is going to get sold off. But the significance of all this is money is coming out of crypto. That's obvious. right? All these stocks are getting obliterated one after the other. Stocks down 70, 80% or more that are Bitcoin treasury companies, Bitcoin exchanges. The whole thing is imploding. But not only is this good for gold in that it's going to, put gold, back in front, right? It was on the back burner. Everybody was focusing on Bitcoin because, Bitcoin is better than gold. Bitcoin is gold 2.0, right? It's doing so much better. Well, clearly gold is doing much better than Bitcoin. And so the conversation is changing in favor of gold. It's get rid of your fool's gold, buy real gold. So that's bullish for gold because money that was being diverted into crypto can now go back into gold because investors want less risk. Bitcoin is more risk. Bitcoin is about the riskiest thing you can own. So if you're trying to de-risk your portfolio, right, you don't want Bitcoin, you want gold. But also, as the Bitcoin bubble collapses, that hurts on paper U.S. economy. The GDP is going to be impacted. Unemployment is going to rise. A lot of people that work in the crypto industry, not only are they going to lose their life savings if they have it in crypto, but they're going to lose their jobs. They're going to lose their income. So this is going to mean, more Fed money printing, and that also is going to end up being bullish for the price of gold. But a lot of other stuff happened that's bullish for gold this week, apart from just Bitcoin falling apart. And first, before I get to that, one of the factors that is hurting the risk stocks is the fact that a rate cut in December is no longer a sure thing. It's basically a coin toss at this point, based on a lot of comments made by FOMC members that they're not really sure, what they're going to do with rates. And so that was hurting risk assets. But it's interesting, money flew into gold and silver, even though they're talking about not cutting rates. People think, that should harm gold and silver because, gold and silver want interest rate cuts. But because they may not cut rates, investors want safe havens, and that's gold and silver. And by the way, it doesn't matter to gold and silver if the Fed cuts rates or not. What matters is they're not raising rates, and they should. Interest rates are too low. They were too low before they were cut. They never should have been cut. And because they were cut, and because everybody knows the Fed's not going to hike, no matter how high inflation rises, well, that's bullish for gold.
The current market setup reflects both strength and necessary caution. After several rapid vertical surges from the mid-2000s up toward the $4,000 level, the pace of gains has become unusually steep. These kinds of advances can mark the beginning of a decisive breakout, but they can also signal the need for a healthier consolidation phase. What stands out is how repeatedly the market has defended the $4,000 zone. Each dip beneath it behaves like a submerged beach ball, pushed down only briefly before snapping back upward with force. That pattern signals firm underlying demand, even as volatility increases. This steady support reduces the risk of a deeper technical breakdown. If the market were truly overstretched or entering exhaustion territory, a slip into the mid-$3,700 would likely have unfolded already. Instead, price action continues to stabilize near key support, suggesting that the consolidation is building a stronger foundation for whatever comes next. The longer this base holds, the more credible the next sustained move higher becomes. Let's get back to the interview.
What the Fed is saying without saying is that we're in for stagflation, and, makes me nervous because to say we're in for stagflation, the obvious corollary is, so that's good for gold and silver. But with gold over $4,000 and silver close to 50,
How much better can it get?
Right, and I'm sure you have plenty of guests who will argue why it has to go to 6,000 or 10,000 or whatever. And I'm not saying they're wrong. It just makes me a little nervous because we had a hockey stick from 2,500 up to 3,000. We waffled a bit, and then we got another hockey stick. So if it hockey sticks again, that's 3 in a row. That's a pretty tall ask. I'm not saying it can't happen. Could be the stagflation story kicks in, and we end up with Goldbug's dream come true, right? The next blow off top. So honestly, and I'll let you go with the next question here, I would much rather see actually a period of consolidation. I think that would be healthy, and it would give me greater confidence in the longevity of this gold bull. Whereas if we go right away into that blow off top, We all know what happens after the blow-off top. And
usually
so don't forget to take profits. I'm not predicting like gold's going to the moon, but it's striking to me that we're heading into an environment that should be bullish from gold, and we're heading into it from a level from 4,000. You know, that's kind of exciting. This is the equivalent of me pounding the table, I guess. I try not to do that, right? But one more thing on this. It's really interesting to me that gold is doing that beach ball thing. Like it's gone under 4,000 and it just keeps coming back up again. And when gold hit almost 4,400, right, and then rolled over and it started going down, it was reasonable to say, where's the floor, right? And a reasonable, at least psychological, if not technical level would have been 4,000. Does it hold 4,000? Because if it kept going down through that, you know, the technical guys would say your next Fibonacci is like 37 and change or something. You know, that would be a significant pullback, or a much bigger one than we've got now. Almost officially a bear market, right? So the fact that it doesn't seem to be going there, that it's catching a bit, that's really telling to me. If this continues, the longer this 4,000 consolidation goes, like if it did the same thing at 3,000, did the same thing at 2,000, like, and then what happened? It went up to the next big leg up. So the longer this consolidation goes, the more confidence I will have that the next big move will be up, not down. Right now, honestly, the next big move could still be down.
Yeah.
Silver's always been more volatile than gold. I do think that the thing I'm watching is that even your most diehard silver uber bulls will tell you that silver lags at first. But it's okay, don't worry, because silver always catches up at the end, more than catches up at the end. Fine, I agree. Historically, this happened 9 out of 10 times. But if we're in the catching up at the end phase, that implies that we're in the end phase, right? And I don't think that's true. So it was concerning me that silver recently was screaming north faster than gold was. But we have a proximal cause for this: the squeeze, the physical squeeze in London. You know, the price to borrow silver in London to meet physical demand, you know, skyrocketed enough to fly some silver from New York back to London, and apparently more of it came from China to help resolve this. But I like this because, you know, silver's kind of reverted to trend. Like it started more than catching up with gold, and now it's reverted to trend. And that's good for the longevity of this market. You have more time for all of us to make money here. One kind of nervousness is this is it, the market is done, we got to get out. And there's nervousness of, oh, it's gone really high and maybe it's time to lock in some gains and things. And it's quite different. And this is why I think the beach ball thing with $4,000 gold is so important. Because if it was the nervousness that, oh, like this is a nosebleed valuation, it's irrational, it's got to pop and then go into a bust mode, which we could say about other markets today, maybe. You know, if that's the nervousness that we had, I don't think gold would have stopped at 4,000. I mean, I think it would have blown through the Fibonacci and easily gone back to 3,000, maybe even lower. That didn't happen, or at least hasn't yet. That's why I say the longer we consolidate here, the less I worry about that. Whereas the nervousness that, oh, gee, this is faster than we expected, clearly that there was a yes there. There were people who were ready to lock in gains the moment it seemed like things rolled over. And by the way, I was one of those.
The recent behavior of digital assets and speculative equities is becoming an unexpected tailwind for precious metals. As leveraged positions unwind and formerly high-flying sectors experience sharp declines, the psychological shift underway is unmistakable. Confidence is shifting away from momentum-driven assets and toward those backed by tangible scarcity and enduring monetary relevance. This shift is visible not only in liquidity flows, but also in how investors reassess the role of metals as stabilizing anchors in an uncertain environment. At the same time, the strain emerging within the crypto-linked economy carries broader consequences. Weakening token values, financial stress among firms, and industry-wide layoffs contribute to a softer economic backdrop, increasing the likelihood of further monetary support. That setting naturally reinforces long-term demand for stores of value. Precious metals have demonstrated their ability to withstand these shifts, highlighting their resilience as other sectors struggle. It's a dynamic that suggests more significance behind these moves than simple short-term volatility. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.